Hey there, students. In this video today, we're going to be talking about units of activity depreciation method. Now, sometimes this is called units of production, but the key word here is units. That's how you're going to know how much to depreciate. Now, what are units? Well, it's just a unit of measurement. Now, different types of fixed assets will have different units that they use to determine how much to depreciate. For example, a machine or equipment, if you'd like to call it that, their units would be machine hours. Now, let's say you have a car. I'm sure a lot of you do have a car. That's an easy one to identify with. Units for a car would be miles. Miles driven. The more miles you drive, the more that car depreciates. The more you use the machine or equipment, the more machine hours accumulate, therefore you will depreciate it more. Simple as that. Now, units of activity or units of production, how do we calculate the depreciation expense? That's the question. Well, the formula is actually really similar to the straight line formula. Let me show you here. So you take the cost, and again, we talked about that in the straight line video. The cost is pretty much whatever gets that asset or fixed asset ready for its intended use. And we'll talk more about that in a second when we practice a problem. So you take that cost and you always subtract that salvage value. And another name for that salvage value is residual value. It's the trade-in value. So whenever that fixed asset is completely used up, you can go ahead and trade it in for a certain value at the end of its life. And you divide this whole thing, that's a division line, you divide that by expected or maximum units. You're like, expected units, max, what does that mean? Well, all that really means is that if you have a car and you expect to drive it for, let's say, 200,000 miles, and at that point, you're going to go ahead and trade it in. So 200,000 miles is the maximum amount of activity that that car can stand. 200,000 miles or units until it's fully depreciated, and then you trade it in for something else. So that's expected units or maximum units, and that's going to equal your depreciation per unit. From there, you can apply that to how many miles you drove or how many machine hours were used. Simple as that. So let's go ahead and take a look at a practice problem, and we can go ahead and apply our knowledge from this video. Okay, so now we'll move on to the practice problem here. So Ideal Time, they purchased a delivery vehicle in January of 2011 for $76,200. So that's going to be your purchase price there for this vehicle. Very important. Now this vehicle is expected to last for 250,000 miles in its life. They will pay $3,500 to paint their logo on the vehicle. $50 is the cost of the annual license fee. 2011, they drove 16,000 miles. And 2012, they drove 14,300. This vehicle has a salvage value of $2,840. Okay, so the very first step in all depreciation problems, like I said in my previous video on straight line depreciation, you need to get the cost first. The cost of that fixed asset is very important. Now, how do you calculate that cost? Well, it's basically any type of expense that can be considered getting that asset ready for its intended use. There's a long list of them. Now, purchase, obviously. So the purchase price always comes first here. So you purchased it, and it was for $76,200. Now, next, what else would go into this? Well, they're using this vehicle for their business. It's a delivery vehicle, so they must have a logo on there so that people can see what their business name is so they can do some advertising. So $3,500 to paint a logo on the vehicle, definitely, because you need that to get the asset ready for its use. So logo would definitely be part of it. It's going to be $3,500. Now, this $50 license, it's an annual license, so you have to renew it every year. So that does not get the vehicle ready for its intended use. Usually renewals are not considered part of that cost. And once again, if you don't know, I did do a little video on what is depreciation that you should look at before this video. It'll help out a lot in laying the foundation for this concept. But once again, these annual license fees, you do not capitalize them. Capitalizing means taking an expense and putting it in your asset. That's capitalization. Anyway, so this $50, not part of the annual license fee. Or sorry, not part of the cost of this vehicle. It's an annual license fee, so it's not considered capitalized. Now, what else would go into the cost of this vehicle? I don't see anything else. So this will be your total cost here. Remember, that's always the first step. Get your cost. Very important. So this will be $79,700. Now from here, we need to go and figure out what is the formula so we can plug in some numbers. So I'll write the formula over here and do a little dividing line. So the formula is taking your cost, deducting your salvage value, and I'll do SV for salvage, divided by expected units for that fixed asset's life. And in this example, this is a delivery vehicle, so those units will be miles driven, to figure out what is our cost per mile that we're going to depreciate it. Or you can call that your depreciation rate. So cost, let's plug in some numbers. 79,700 minus salvage of 2840 divided by total expected miles was 250,000. Okay. All right, so it comes out to be about, this is your depreciation rate. You're going to depreciate this vehicle at a rate of 31 cents per mile. So every mile you drive, you depreciate it at 31 cents. So let's go ahead and figure out what is our depreciation for 2011 right here. So you drove 16,000 miles. So let's go ahead and we're going to go ahead and calculate that. I'm going to do it over here on the left side. So I'm going to do a little line, separate it out. So 2011 and 2012 right here. 2011, you drove 16,000 miles times 31 cents a mile. 2012, 14,300 times 31 cents. So let's see what we get here. And again, I rounded up on that rate to 31 cents. 49.60, that's how much you depreciated in 2011. In 2012, you depreciated at 14,300 times 31 cents. So your depreciation expense for 2012. And there you go. And this is your depreciation expenses for each of those years. So there we go. We answered our questions. 4960 and then 4433. What is the book value of the vehicle? Well, I'll do another little line here to separate this out. Book value, all that is, you just take your cost and you subtract accumulated depreciation. Accumulated depreciation, all that is the sum of your depreciation expenses. That's it. And we only have two here, so 2011, 2012. Add these two numbers together, that's your accumulated depreciation. And you get 9393. So we'll just plug in some numbers here. Our cost was equal to 79,700 minus 9393 for accumulated depreciation. So that's your book value. Subtract those out. 70,307. That's your book value. So I'll go ahead and write that up here. Book value. All right, it's a lot of steps there. But if you just follow that formula, make sure you get your correct cost first, write down your formula, plug in the numbers, get your rate of 31 cents a mile, and then go ahead and apply it to each year, 2011, 2012. Get your accumulated depreciation by adding up your years, subtract that from your cost, and you get book value. Not too bad. Hopefully that was helpful for y'all today. Please feel free to rewind, fast forward, whatever you need to do to make sure you learn this concept. And please comment below if you have any questions. And also you can give me some feedback too. I'd love to hear from you. Please go ahead and subscribe if you like this video. I'm going to release about 3 different videos each week that will help you with your accounting. And also if you have an accounting topic that you want me to do a video on, comment below and I can help you out. I'll create a video for you. And please give me a thumbs up if you like this video. I'd really appreciate it. Once again, thanks for listening today, and I'll see you in the next video.